This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
The next bit is still terminology, but the way they are quoted in the newspaper. And he will test you this. You know, I said in the newspaper, you've all seen, they list share prices and so on. Well, they will also list the prices of these certificates. And the way they quote it is like this. Let me write one down and use this to explain the terminology. What you might see is this. 12% loan stock, 2015, 95 PC. Well, I'm going to tell you what everything means, sorry. That's just an example. But he expects you to understand what everything there means if you look at it the way it's quoted. First of all, the 95 at the end. I said these can be bought and sold just like shares. And just like share prices, you all know the price of shares on the stock exchange goes up and down for various reasons. We'll say a lot more of the theory of why later. But equally, the price of these certificates goes up and down as well. It's going to be the company. If Marita wants to sell a certificate to editor, basically they can pay whatever they want, sort of thing. Well, the 95 PC is the market value of one certificate. And I said one certificate, the units were 100. So it's the market value for $100 nominal. Now what I mean by that, Marita lent me 100. She got a certificate saying, I owe you 100. She'll get interest on $100. She'll get repaid $100. Clear? The nominal value. If she wanted to sell her certificate today to Rita, the price on the stock exchange in theory could be anything. Well, we're saying today she could sell the certificate to editor for $95. Alright? Is that clear? Out of interest, although it's again a later chapter, can anyone tell me? Marita lent me 100. I'm going to give her interest on $100. Editor buys it off her. Why might it be that editors only began to buy $95? Why won't she get 100? Lots of possible reasons, but there's one very obvious one. Yeah, there's something much more obvious. That's what that Agnes was saying. No. Before I answer, tell me, what do you think that 12% is? The interest. You know, that 12%, I've promised that we'll pay, when I issue them, 12% interest. That is the interest rate on nominal value. Marita lent me 100. She'll get $12 a year interest, whatever happens. Okay? Marita sells it to editor. Editor's going to get $12 a year interest. Clear? Can anybody suggest a reason why? It's a few years later, why editor is only prepared to pay 95 and not 100. Not because of that, no. Indirectly, but that's not the word I was looking for. When it's used the word discount, this is how it is. Tell me, how many dollars interest will Evita get if she buys this certificate? How many dollars a year will she get? 1.2. The certificate is $100. How many dollars a year interest will she get? She'll get $12 a year interest. Do you agree? Suppose I tell you interest rates, this at the moment, she can put money in the bank and get 15% interest. If she can put money in the bank and get, Evita can put money in the bank and get 15% interest, why on earth should she pay $100 to marry her when she's only going to get 12%? Do you see my point? She's only going to get $12 a year. There's no way she's going to pay $100 for it. She'll pay less for it, surely, if interest rates these days are higher. Would you agree? Or equally, it could work the other way. If interest rates now were only 6%, and this certificate gives her $12 a year, Marita's not Santa Claus. Marita's not going to say, give me $100 and I'll give you $12 a year. Marita's going to charge you $200. She'll get $12 a year, which will be 6%. You understand me? Anyway, we'll do a lot more of that tomorrow, which is where the real theory comes in. The point is, though, don't worry, I think that should be obvious, but don't worry too much. But the point is, the market value today is 95. That's the market value. We don't usually print PC. If you ever see PC, it's just telling you it is for $100 nominal. Okay? The 12% is the interest on nominal. So as I've said, whatever the market value is from day to day, the owner of the certificate will get $12 a year fixed. But finally, what do you think the 2015 means? 2015 would be the repayment date. The actual documents, obviously, would be more precise, but in the newspapers, they simply print the year of repayment. So anybody with that certificate will get $12 a year until 2015. Then they will be repaid. All right? So, not quite there, but nearly there. Are you all still okay? Fine. Next thing, though, still relating to what's on the screen. Not all investors are accountants. They're not all as clever as you. And as a result, when you look at prices on the stock exchange, the newspapers print 2 extra bits of information to help investors. And the first bit, I think, is very obvious. Would you agree? If you were deciding to invest your money, the obvious thing you'd be interested in is what rate of interest you're getting. You know, the more interest, the better sort of thing. All right? And somebody like my grandmother might look at that and say, oh, they're paying 12%. That's good or that's bad, you know, compare it with. But of course, I just said when I was using Evita as my example, if you were to buy this certificate on the stock exchange today, you wouldn't actually be getting 12% interest. If you bought it today on the stock exchange, how much would you have to pay for it? Say again? 95. On the stock exchange, I can buy it from Marita or whoever for 95. And how many dollars a year interest will I get? $12. Because the company's paying 12% of 100. You with me? And so anybody buying it on the stock exchange, they'll pay 95, they'll get $12 a year interest. But of course, that's not 12%. Do you agree?
Yeah.
Now, that may be obvious to you, but to help people like my grandmother, that's printed on the newspaper and it's called the interest yield. The interest yield is defined as being the interest per annum as a percent of the market value. And so again, always do it on one unit. But if you've one unit, nominal value 100, the company will be paying you $12 a year. Somebody buying it today on the stock exchange would only have to pay 95. And so in fact, Evita would actually be getting 12 on 95. Is it 12.6%? Has anyone checked me? So again, it's easy arithmetic. There's no tricks there. But as I keep saying, sorry if it's tedious, but you must be happy with the logic. You can't just learn the rules here because there's lots of written. Is everybody clear? That's sensible. And of course, you all agree that's useful for an investor. If I gave you a whole series, you can buy loan stock in this company, this company, this company. They might all have different interest rates on nominal. But surely if you were deciding which ones to buy on the stock exchange, what matters to you is more that interest yield. Do you agree? That's the real return you'll be getting on the money. Okay. There's one other term I expect you to understand that's printed. Now, as you see, I never actually asked you for numbers here, but would anybody like to tell me if Evita buys this today, she'll pay 95. She'll get back $12 a year from the company, and you've all agreed. That means she's effectively getting 12.63% each year. True? Would anyone like to tell me then why, in fact, overall, Evita will end up getting slightly more from this particular one? She'll end up getting slightly more than 12.63. If she buys it today at 95, she'll end up actually getting a little bit more than 12.63%. Right, I tell you what. How much did Evita pay today? 95. How much interest, how many dollars is she getting each year? 12. Until 2015. In 2015, she'll get repaid. How much will she get repaid? 100. Yeah? The company promised they'd pay 12% on 100, 12 a year. They promised they'd repay it in 2015. You agree? Evita's only paid 95. She will get her 12 a year, 12.63. But in whatever it is, 5-6 years' time, she gets what we might call a little bonus. She gets an extra 5. You all see that? And does that not mean that over the whole period, it actually averages to a little bit more than 12.63? Well, it's an extra $5, but it's over 6 years, So I don't know, maybe that's an extra 0.5% a year or something. But you all see it would be a little bit more. Well, in F9, you cannot be expected to calculate this figure. It's actually very easy, but it's not in your syllabus. But you're expected to have heard of it. They print it in the newspaper, the overall return she's getting, and it's called the redemption yield. Now, as I say, you cannot be expected to do numbers on it, but he does expect you to know what it means. The redemption yield is, it's hard, there's no proper words here, but it's what you might call the overall return per annum. So it's quoted as a yearly rate. But when I say overall return, I mean not only the interest. We already know she's getting 12.63% interest. But in addition, the gain that she's getting on repayment. It's sort of spread over the 5-6 years, but the gain on repayment. Now, I've said you can't be expected to do numbers, but it's to try and make it clear what I mean. You are happy where the 12.63 came from. That's the actual interest each year. You all agree out she's effectively gaining $5 on repayment. Well, it's like spreading that $5 over these 6 years and saying, oh, on average, it's like an extra 0.5% a year. You see the sort of thing I'm doing? And so I'm making up a figure here, but for this question, you might have the redemption yield, perhaps is 13.2%. It's quoted as a yearly rate, but it's a little bit more because of the fact she's not only getting interest, she's getting an extra $5 a year. Okay. Finally, though, it can work both ways. Look at this. Can you all do this for me? It'll take you 10 seconds. What about this? Suppose we've got 15% debentures, 2016, quoted at 112. Now remember, the 112 means the market value today of $100 nominal is $112. That's how much you'd have to pay to buy it. Clear? Can you all write down for me? What is the interest yield? And secondly, that I actually want a figure for. Secondly, though, the redemption yield. Well, as I've said, you cannot be asked for a number. You can probably guess already. I want to know, is it more or less than whatever you get for the interest yield? So the interest yield, I want a number, and then a comment about the redemption yield. Alright, well, it's quick numbers, so you should be able to do it quite frankly. Anybody got a figure for the interest yield? Don't be shy. I don't know. Well, check my workings. On $100 nominal, you'll be getting $15 a year, whatever happened, 50% of nominal. Buy it today, though, and it would cost you $112. And so you should have got 13.4%. So year by year, you'll be getting 13.4% interest. Okay? And the redemption yield, well, it's difficult to make a fun question out of it, because I keep saying you can't ask numbers. But will the redemption yield be more or less than 13? It'll be less. Because you pay 112 today, you get nice big interest each year, 13%. But of course, when in 2016, when it's repaid, you'll only get back 100. So this time, you'd be losing on repayment. Do you all agree? And so it's getting nice big interest year by year. But in 5, 6 years' time, whatever it is, you're losing this time 12. And so the overall return, again, this spread that loss, if you look at over the period. And so the redemption yield will be lower. Again, I'm making up a figure. What would it be? I mean, because I say it's much more complicated than just spreading it. But $12 over about 6 years is about $2 a year. But it's $2.112. A bit less than 2%. I don't know. I'm inventing a figure, obviously. Maybe it came to 11.6%. But be clear, that's invented. What's important is you are on what redemption yield is showing. Yeah. And here, I'll make you think around. And it's actually, again, I don't want to bore you, but it's actually terribly, terribly useful. Because if you look in the UK, certainly, where you've lots of different debentures, loan stock, different companies being quoted, you will find you've got some like the first one, where the first one is what? It's paying lower interest than this one. It's only paying 12.6. But the redemption yield is higher. You're going to gain on repayment. But equally, you have others you can choose where the interest yield might be higher, 13.4, so you're getting higher interest each year, but you end up losing on repayment. You with me? And it's terribly nice. I'll tell you why. You, I think, are all working and you're young. If you were investing, you're probably less worried about the income because you're getting salaries. You'd be more interested in the value growing, you know, with inflation things. And so you might prefer, I've lost my mouse. You as young working people might prefer the first, where you're getting lower interest, but you will get a bigger repayment. You with me here? And it can often be more extreme, you know. You might get ones where the interest is only 8% or something, but there's a very big profit on repayment. On the other hand, old people like me, maybe I don't even expect to live to 2016 or something. You know, if you're old, you're perhaps more concerned about your income, and you don't care about repayment. You might be dead, and that's somebody else's problem. An old person might prefer that one, because they're getting higher interest each year. They will lose on repayment, but you know, they're dead anyway. That's your children's problem, you're not worried. You see my point? It's lovely. You find they all give a similar overall return redemption yield. There's something very high interest and we lose at the end. Some give much more than Christian theology. You get actions. Okay.